This is our Forex blog for January 5th, 2012, and like most days we want to buy the absolute strongest currencies versus the weakest. And we compare each currency to every other one on multiple time frames using multiple tools. The histogram on the top is made up of 5 different statistical tools we've come up with over the last 6 or 7 years, and we average them together. 3 of them measure the direction. In this case, the dollar is going versus the yen, the euro, the Swiss, the Australian, all the major pairs. And the other 2 indicators we average in there measure the intensity of that direction. It's one thing if the dollar is going up against 80, 90, 100% of all the currencies, but if it's doing so with very low volatility, it's still not worth trading. So anytime you see a reading at and above the 80 level here, not only is the dollar going up against almost all the other currencies, but it's doing so with intensity. If you don't see it at and above the 80 level, then it might be going up against a good percentage of currencies, but it's just slowly drifting up. That trend could continue or, very likely not continue. You never know. It's a gamble. And so when you have high intensity trends, they tend to continue more. And currencies don't move one way forever. They go up, they go down, they go up, they go down. And this measures each wave. If you see up moves having more intensity than down moves, then the up, the momentum is likely to continue up. Underneath that, we have the daily, weekly, and monthly trend. I primarily focus on the daily and the weekly. In this case, the dollar's trend for the weekly and monthly trend is down. So if you see some momentum in it today, it could continue like it did today, and later on today it shifted its weekly trend up. Or, it could go up for an hour and a half, 2, 3 hours, and then go down the rest of the day. The yen, on the other hand, had a weekly and monthly trend that was up. So if you see some momentum in this, it's much more likely to continue. And in this case, it did for a few hours, and then some weakness came in. It doesn't always happen that way. As you can see, the dollar was consistently stronger than the yen, despite the yen having a weekly and monthly trend that was up versus the dollar being down. Now, the euro, daily, weekly, monthly trends down, and from about 1 o'clock it had some weakness, a little bit of strength right here, and then coming up to 4, a lot of weakness, less strength. That trend is likely to resume itself down because the daily, weekly, monthly trend is down. I don't care about the monthly trend. I primarily use the monthly trend in some instances to trade more lots. If the weekly trend is down, the monthly trend is slightly up or very strong up, I'll still focus on trading it on the downside, but I will do fewer lots because the chances of having a big win are less. And it's all about the odds. Sometimes the odds, come to your favor, and other times the market changes direction. Like the Australian was very strong the previous few days. The weekly monthly trend is one of the strongest, but it was weak most of the day. However, after a currency pulls back, there's a lot more people trying to buy stronger currencies on pullbacks than they are trying to buy the super weak euro. Nobody is really looking to buy the euro at the lows, but they are looking to buy the Australian on pullbacks because it is very strong over the weekly monthly. So, you can have weakness for a couple hours and then you see some strength followed by less weakness. That strength's likely to continue because the weekly monthly trend's up. So at 8 o'clock right here, it was pretty safe to be looking for a buy in this. And the 2 weakest ones are the euro and the Swiss. This isn't a currency that we leave running for our classes, so I'll bring it up here. The euro Australian coming up to 8 is very likely to go down, and as you can see it did. It fell from 2,500 all the way down to around 60. It's a 40 pip drop. Then you got a nice little pullback right here. You might have got into a trade, lost 10 pips, got short again, and the market kind of went sideways and down. Double bottom right here, you would have been out. So you had a 40 pip win, maybe a 10 pip loss, and then this last one you got in around 90, and you're probably still in it with your stop above 70, so you locked in 20 pips. So you got 20 pips minus the 10 pip loss. That's 10 pips plus 30 or 40 pips here. You're up 40, 50 pips in this currency, and it could break the lows right here because the euro is very weak and the Australian is strong longer term. So today, some of the highest odds trades, obviously the yen had all the time frames up, and especially when it had a lot of momentum here, followed by very little weakness. That trend's likely to continue. All the time frames is one of the strongest ones across the board. Coming up at 4:30, what was one of the weaker ones? The euro had extreme weakness followed by less strength. So the euro yen at 4:30 would have been a great one to be looking to sell. Here is 4:30, and you can see this currency was underneath the hourly. It had a false breakout above the hourly right here. At 4:30, actually, it had already fallen down here and had a little bit of a pullback. You might have sold this here on this pullback somewhere around 85. My Fibonacci profit target analysis I do each night. So you have a potential of about 20-25 pips while risking 10. Anytime you sell a currency on a pullback, I typically will put my stop a pip or two above the high. So you would be short this around 86 with a 92, 93 stop. Less than a 10 pip stop, and the Fibonacci profit target is down here. I have a range for that, but the actual number is always in the middle of this at 61. So 61 is your profit target. It's got a 25 pip potential profit, and you're risking less than 10 pips. So this meets our risk versus reward ratio. The minimum is 1.5 for experienced traders and 2 for novices. So what that means is if you're a new trader and you're not experienced yet, you're going to have more losing trades. You're going to make more mistakes. Only take trades that are likely to give you 2 times more profit than your risk. Obviously that doesn't happen every time, but when it does, you will have bigger wins than your loss. And sometimes the market goes even farther than the next profit target. It could shoot through this and move another 20, 30 pips. So occasionally, small percentage of the time you have huge wins. The rest of the time it hits your profit target and you're out. But when it does, you have 2 times or 3 times bigger profits than your risk. Again, for advanced traders, take trades that have 1.5 times. So if you have a 10 pip stop, it means you can take a trade where the profit target's 15 pips away. And again, it can shoot through there, and it also could be a loss, and it also could be a break even, and it also could be a 5 or 6 pip win. You don't always get what your profit target is. But also, the good news is once you're in a trade, your trailing stop starts to go with you. So if the market moves your way at all, your stop loss, how much you lose, is less. And once it starts going down, it very quickly goes to break even. So some trades that don't work out, you have a break even versus a loss as well. That's the positive part of that. The Swiss also very, very weak today. So selling the Swiss yen makes a lot of sense. As you can see, this had a multi-hour rectangle pattern. This is one of our trading methods. We have 2 major entry methods: pullbacks and sideways rectangle patterns. This is in about a 10 or 15 pip range for many hours. Then it breaks down, and you can see it fell about 35 pips. Then you got a little bit of a pullback here. I typically won't take a trade unless it pulls back at least 15 pips. The more volatile the currencies, the more it needs to pull back to make the risk versus reward. Plus, some of the more volatile ones have wider spreads, so your risk is automatically higher. You're going to have a bigger loss in the more volatile currencies because of the wider spreads. Let's look at this again here, the Australian versus the Swiss. The Australian was very likely at 8 to go strong again. Here's 8 o'clock. You can see it made a higher high. One of the secrets of trading is not only using our tools that statistically quantify how strong or weak each currencies are, but one of the old school ways that is extremely good is anytime a currency makes a higher high than the previous high and then a higher low than the previous low, it's positive. And oftentimes during sideways rectangle breakouts like this, you'll have a false breakout. It comes back, finds support right at the previous breakout level. That's a very positive sign. So at 8 o'clock right here, you knew ahead of time to be looking for this using our currency meter. You always want to draw your Fibonacci's on here to get an idea where your profit targets are. This is your first profit target here at 97.67. You would be buying this at 51. So it's got about a 17 pip profit while risking about 10 pips. And aggressive traders really, once it came down here and did a retest at this support area. Resistance areas once broken become support, and once it breaks out, you really could jump the gun right here because the currency meter also is showing it at 48 versus maybe 52, 53. You get in there 3 to 5 pips earlier, and you have therefore a smaller number of pips risk. You always want to put your stop underneath the swing low. And here's your first profit target. Again, it shot through that and went to the second profit target up here at 97.77. So even if you got in this at 53, you have about a nice 24 pip win while risking 6 to 12 pips. That is good trading at its that is the epitome of good trading.